and welcome to the next video in the course of Quantitative Finance in Python. In this video, you will learn and get a basic introduction to the financial markets. So, there are different type of financial markets in the world that we are living. The stock market, commodities market, currency or forex market, the bonds and fixed income instruments market, and finally the cryptocurrency markets where you have different cryptocurrencies like Bitcoin, Ethereum, etc. etc. So these are the different kind of financial markets that we have. And first of all, let us start with the introduction to the stock markets. So stock markets are venues where buyers and sellers meet to exchange equity shares of public corporations. So if you want to buy some equity shares in the public company, then stock market is the place. So stock markets are components of free market economy because they enable democratized access to investor trading and exchange of capital. Stock markets create efficient price discovery and efficient dealing. The term stock market refers to the several exchanges in which shares of publicly held companies are bought and sold. So, equities of companies are bought and sold in stock markets. Now, what moves the stock? So, what moves the price of the stock? So, we'll understand this with the help of a case study. So, imagine you are a market participant and you are tracking a company called Infosys. Infosys is a large IT giant in India. So, it is 10 a.m. Infosys is trading at 3,000 rupees per share. The management makes a press statement that they found a new CEO expected to steer the company to greater heights. So they are confident that the newly appointed CEO will do good things for the company. So here I have two questions for you. How will the stock price of Infosys react to this news? And if you were to place a buy or sell order in Infosys, what would it be? Now, would you buy it or would you place a sell order? Now, the answer to the first question is quite simple. The news is positive, so the stock price will increase. Infosys had a leadership issue and the company has fixed it. So when positive announcements are made, market participants tend to buy the stock at any given price, which cascades into a stock price rally. So we'll understand this further with the help of this example. So the time is 10 a.m. and the last traded price for Infosys is 3,000 rupees per share. Now what the seller wants is 3,002. The buyer buys and the new LTP or the last traded price becomes 3,002. Now after 1 minute, the LTP is 3,002. The seller wants 3,006 and buyer is ready to pay higher price. So the LTP becomes 3,006. Same if we move to 10:03. Now 3,006 was the LTP. The seller is asking for 3,011. Now buyer is ready to buy the stock at 3,011 and the LTP becomes 3,011. 10:05, the LTP is 3,011. The seller wants 3,016 to sell the stock. The buyer is ready to buy the stock at 3,016 and the LTP becomes 3,016. So Infosys was trading around 3,000 rupees at 10 a.m. Now it is trading at 3,016 at 10:05. So this is how the stock price is moved. Now notice that the buyer is willing to pay whatever prices the seller wants. This is when the market is said to be bullish. So in a bullish market, the prices tend to move up. So as you can see, the stock price jumped 16 rupees in a matter of 5 minutes. Though this is a fictional situation, it is a realistic and typical behavior of good stocks. So the stock price increases when the news is good or expected to be good. In this particular case, the stock moves up because of the two reasons. One, that the leadership issue has been solved, and two, there is an expectation that the new CEO will steer the company to a greater height. So this is how the stock moves. Now let's discuss the answer to the second question. So the answer to the second question is now quite simple. You buy Infosys stock because there is good news surrounding the stock. Now moving forward, let's say on the same day at 12:30 p.m. the National Association of Software and Services Company, that is NASSCOM, makes a statement stating that the customer's IT budget seems to have come down by 15%, which could have an impact on the industry in the future. For those who are unaware, NASSCOM is a trade association of Indian IT companies. So it is saying that the customer's IT budget seems to have come down by 15%. So which will create the negative impact on the IT industry in future. Now by 12:30 p.m. let us assume Infosys is trading at 30:30. So 3030. Now here are again few questions for you. How does this information impact Infosys? Now what would it be if you were to initiate a new trade with this information? What would happen to other IT stocks in the market? So the answers to all the above questions are quite simple. Now before we answer these questions, let us analyze NESCOM's statement in more detail. So let's say NESCOM says the IT budget is likely to shrink by 15%. This means the IT company's revenues and profits are likely to go down soon. So this is not a great news for the IT industry. So Infosys is a leading IT major in the country and will react to this news. The reaction could be mixed because there was a good news specific to Infosys earlier during the day. Now, however, a 15% decline in revenue is a serious matter, and hence Infosys stocks are likely to trade lower. So at 3030, if one were to initiate a new trade based on the new information, it would be a sell on Infosys. So the information released by NASSCOM applies to the entire IT stocks and not just Infosys. Hence, all IT companies are likely to witness a selling pressure. So, as you notice, market participants react to news and events, and the reaction translates to price movements. This is what makes the stocks move. At this stage, you may wonder what would happen to a company's share price if there is no news. So, will the stock price stay flat and not move at all? The answer is yes and no, depending on the company focus. So, for example, let us assume there is no news concerning two different companies. So first one is the Reliance Industries and second is Sri Lakshmi Sugar Mills. So as we all know, Reliance is one of the largest companies in India, and regardless whether there is news or not, market participants would like to buy or sell the company's shares, and therefore the price moves constantly. The second company is relatively unknown and it's a small company. Therefore, it may not attract market participants' attention as there is no news and events surrounding this company. Under such circumstances, the stock price may not move, or even if it moves, it will be very marginal. So, to summarize, the price moves because of expectations of news and events. The news or events can be directly related to the company, industry, or the economy as a whole. So, for instance, the appointment of Narendra Modi as the Indian Prime Minister was perceived as a positive news, and therefore the whole stock market moved. In some cases, there would be no news, but still the price could move due to demand and supply situation. I hope you are clear with the concept of stock markets. Now, let's move to the next part of the video, and there we'll discuss about other markets like foreign exchange market, commodities market, crypto market, and the fixed income market. Thank you. Let's move to the next video.